Hi, welcome once again. So we are proceeding with our module. This time around, we are looking at internal controls and internal audits. We'll split it into two parts as usual to make it quite lively and easy to navigate through. So we'll be dealing with internal controls first, after which we'll proceed to look at internal controls and internal audits. Okay, so every organization must have some rules and regulations in place, some standard operating procedures, some risk mitigation measures, okay, in the form of more or less a documented policy, practice, and procedures to ensure that they work to meet the objectives of the organization. If there are no controls, if there are no activities to forestall any risks, if there are no practical guidelines that could help the organization to achieve its mandate, for sure, you should know that this organization cannot survive into the future as a going concern. So we'll just take a look at internal controls quite briefly. It's something we already know, something we've practiced in the past. Okay. And we've seen it in audits, we've seen it in foundational accounting practices or modules. So it is relatively straightforward to look at. What will happen is that in our workshop, we'll look at a more practical scenario. Okay, we'll look at a more practical scenario where we'll be limiting ourselves to how to identify the risk, to put in place some controls, okay, and then or make recommendations so that we can put in place some controls. All right, so for this particular section on internal audit and internal controls, as I said, we limit ourselves to internal controls. So we look at the scope, its definition, and how it is linked to risk exposures. We look at the Turnbull report under the UK corporate governance, the development of corporate governance. We've looked at it in the past weeks, the elements of a sound internal control per this report. And also under the COSO framework or model, there are some five integrated elements of internal control. What are they? That's the model almost everyone uses across the globe. Then we look at the eight main internal control activities, the SOAPSPAM acronym. And then we also differentiate between the various types or classifications of internal controls in an organization. And like I said, the intention here is to be able to evaluate risk management strategies and internal control by applying all that we've studied, all that we've mentioned above, one from 1 to 5, to a real case scenario. If you're in a workplace, how do you identify internal control deficiencies or weaknesses in the operations of the organization? And how can you tell the effect on the operations of the company, operations of the organization? And then you should be able to make practical recommendations to seal off these gaps and possibly try to identify who owns what and who does what in the organization. So, per definition of internal control, we simply say it's a whole system of controls, okay, whether financial or not, whether quantitative or qualitative, which are established by the management top hierarchy in order to carry out the business of the day in a properly manner, in a properly orderly and efficient manner to ensure that these organizational activities will sync with management policies. They will safeguard the assets of the organization, detect, prevent and detect fraud and error, and secure as far as possible the completeness, accuracy, and existence of the records. Okay, so in summary, it simply refers to the system of management to control certain identifiable risks and therefore help businesses achieve their objectives. Remember, we've said there are residual risks. So there could be some controls in place, whether they are robust or not, which they cannot identify such risks. That are peculiar, that are exceptional. Okay. So what we should know is that one, how do these internal risk or internal controls link to risk exposures? We could have a robust, strong, efficient internal control system on paper, but if we don't implement it properly in the organization, we will expose the entire organization to fraud, risk, operational deficiencies. So just on paper is not enough. Number two, we could also have a robust internal control systems on paper, which is also implemented on the grounds. Really, okay, you see the reality on the grounds working. However, if we happen to see senior management, those at the top who do not abide by these controls, they are overriding these controls. then these controls, even though we're implementing it, becomes useless and exposes the company to inefficiencies, ineffectiveness, wastage, fraud risk. Okay. And then thirdly, any poorly designed or non-existent internal control systems will expose the entire company to a barrage of operational risk, and it can cause the company to fail. So three different elements: strongly worded policies on paper, not robustly implemented. You're wasting your time. Robustly implemented, but senior management are overriding it. You're wasting your time. But again, if we don't have it at all, then we are doomed. All right. Now, the internal control systems and then risk management. Let's look at it. Like I said, we can. These were mostly, should I say, suggested or proposed by the good corporate governance systems. Okay, so when we take the UK Corporate Governance Code, for example, it requires the board of directors, okay, to normally be the goal owners of the internal controls, that they should periodically review these internal control systems and to ensure or satisfy themselves that the system is running smoothly, is suitable for the organization, and it meets the operational needs of the company. Now, profits are in part the reward for successful risk taking in a business. In part, okay. Therefore, the purpose of internal control systems is to help manage control risks, okay, so that we will rather boost profits. If nothing at all, we should sustain profits rather than wasting or bridging the gap to which we can make these profits. So internal controls would look at both the profit ventures, the profit revenue generation ventures, the maximization of shareholders' wealth, as well as other non-financial benefits that the company could gain. So profits may not be the sole reason why we institute internal controls, but also we could look at sustainability, okay, corporate social responsibilities, getting a reputation within the system. So as I said, the board of directors are usually responsible for these company's system of internal control. But again, we've said it in the past at the beginning of this module that everyone in the organization has a role to play when it comes to risk management. Okay, so all employees have responsibility for internal control. We must ensure we adhere to it. We must ensure we live by the standards, by the protocols. And then at the end of the day, together we achieve the overall objectives of the company. Okay. Now, in the Turnbull Report of 2005, the UK government um, corporate governance historical developments, we've looked at it in the past. It proposed elements of a sound internal control system. First, it looks at the fact that an internal control system should encompass the policies, the processes, the tasks, the behaviors, and other aspects of a company taken together so that one, it will facilitate efficient and effective operation by enabling it to respond appropriately to any identified significant risks. Normally, when the risks are not significant, we can accept them, we can write them off. But even moderate risks, um, we have to monitor it. Otherwise, we have to ensure we tackle it heads on. Even low risks could migrate to grow to become significant risk. Again, when we take these processes, tasks, and policies together, it will help us to ensure quality of external and internal reporting, both to those outside and those charged with governance within the organization, to everyone. And these, again, sound system of internal control should help compliance with laws and regulations and um, enactment, the decrees within the system. Okay. Secondly, the Turnbull Report stated that the system of internal control should include control activities, information and communication processes, okay, and processes for monitoring the continued effectiveness of the system. And you can see this occurring even in the COSO framework. We'll look at it in the next system. Okay, so the overall system of internal controls should help reduce wastage, number one. It should help improve communication within and out with the organization. It should help us to comply. And again, it should have a holistic approach where we look at both activities, communication, information, monitoring, and evaluation continuously to ensure that these things work. Again, it's looking at the fact that the system should be embedded within operations. It shouldn't be a standalone. okay, more or less like a policing the activities. It should be embedded in the day-to-day activities. We should be able to revise it, to review it, so that it will respond to changing risks, changing developments within the system. And it must also include procedures for reporting failings and weaknesses. And most especially, it should be able to help us revamp the system so that we'll more or less report value, create value, okay, and sustain the value. Now, a sound system of internal control should eliminate. If we can eliminate, yes, that's good. But even if we cannot eliminate, it should help reduce the possibility of poor judgment in decision making and reduce human error. Control processes that deliberately circumvent the systems and it could also help us could maybe prevent us from seeing future risk. So we should look at it more or less in a comprehensive manner. Okay. One more point from the Turnbull Report states that the sound system of internal control should be reasonable. It may not be foolproof, absolute, where it could eliminate every risk, but it should at least minimize or clear as much as possible significant risk from the company. Okay. It should give us an assurance that the company will not be hindered in achieving its business objectives and could operate into the foreseeable future period. Okay. Any foreseen risks should be easily identifiable by these control processes so that we can easily prevent any harm from occurring. Now the COSO model, okay, the Committee of Sponsoring Organizations Treadway Commission 1992 stated that the effective internal control system should have five integrated elements: the control environment, which syncs with the Turnbull Report. Okay, so the control environment looks at management's attitude, actions, and awareness of the needs for the control. So we are more or less looking at senior officials, thrown at the top. Secondly, is look at the risk assessment. We need to identify and assess risks, okay, record them in our risk registers, assign who does what, okay. And then so here we can see elements of internal and external factors and distinguish them clearly from those risks that we can control and those risks which we cannot control. Some are natural factors, external, we cannot control them. Some are internal, human errors, we can fix them, okay. Thirdly, we look at the control activities, the real internal controls, okay. Once we've been able to identify these gaps or the risk in the system, we should be able to implement specific control activities to reduce these risks. Then information and communication, quality information, okay. Who needs what? Communicate to them in proper time, in due time, so that we can work in time to close off any risk or any gaps. And then periodically we need to monitor it, we need to review and assess whether the current control system we have in place is up to task. For example, in our days today, we are looking at automation. So if our controls are all secondary to automation or to IT, it's all manual. Then of course we need to update it to ensure we live up to task. Now, the one main element of internal control is internal audit, okay, and general supervision. So it is expected mostly by organizations that internal auditors should be mandated with the task of ensuring that these internal controls work perfectly in the organization. The human factors the organizations are adhering, are conforming to these controls, and then ensuring that we can review and revise them as and when. Now, let's look at the eight main internal control activities. Sorry. So here we use the acronym SOAPSPAM. They are not in any order. Okay, you can just rearrange them the way you deem fit. Okay, so the first one has to do with segregation of duties, so separation of authorities, chain of commands. Okay, who records the transactions, who handles the assets? Is the one who receives cash the same person who pays cash into the bank account? Is it the same person who prepares bank reconciliation statements or follows up with debtors reconciliation? Be careful. What about organizational structure? We need to delegate authority, set up responsibility centers so that we can know who does what. Chain of command. Arithmetic and accuracy or arithmetic and accounting, we need to ensure figures are recorded correctly and posted into the right account. Okay, double check. Someone should be able to pre-approve and someone should be able to review thereafter. Personnel control, proper induction, orientation to staff, hiring the right caliber of people, the qualified persons to fill the positions. Okay, supervision. We should also have systems in place where we can mentor, we can monitor, we can help those who are new on the system, or even those who may not be new, still need some coaching, some guidance to perform their work properly. Then physical controls safeguard the assets. Okay, do we have a cash still? That helps in keeping our cash, or the cash is just lying down loosely. Our checkbooks. What about our assets, our land and our vehicles? Anyone at all can move a car and drive around without keying in the logbook. Okay. Approval and authorization, there should always be approval limits. Okay. You perhaps the managing director cannot sign checks above 10,000. Anything above 10,000 should be referred to the board for them to approve. And then we have management control, which deals with top level reviews and activity control. So SOAPSPAM, in no particular order, you can rearrange them as you think fit. Okay. All right. So now categories and types of internal controls. Basically, there are two: quantitative and qualitative. But still with the quantitative, they are split into two. We have the financial quantitative. Okay, here in situations of certain financial targets, spending limits. Okay, and examples could include budgetary controls, controls over sales and purchases, payroll and inventory cycles, quantitative, financial to meet our profit targets. Okay, non-financial quantitative controls, they focus on targets against which performance can be measured and monitored. Talk of total quality management, balanced scorecards, okay, where we look at various dimensions, but of course, we set in place key performance indicators to which we will measure performance to ensure whether we are conforming or we are deviating. Okay, so it's important that a feedback loop exists to look at performance targets. Okay, actual results recorded against what we budgeted for. Compare and see if we have deviated. If we have deviated, put in place some control actions. Okay, and then we have the non-financial qualitative. So they form the day-to-day controls over most employees in organizations. Talk of training and development, management control, systems or methods like organizational structure, contracts of employment, physical controls, project management. Okay, so these are more of qualitative, not not specific, numerical in nature, but of course sometimes we can rank them, we can put them, we can assign labels to them just for ease of identification and measurement. All right. So finally, before we wrap up, we should, in order to evaluate an effective internal control system, we look at a cost-benefit analysis. Okay, and we look at this at the commencement of the module. That for every risk we identify or we assess and measure, a cost-benefit analysis will help us to know whether we are going to lose or we are gaining from whatever approach we adopt. So time of the management involved in the system. In terms of cost, what are the elements of cost? Time of management, who developed the system, who reviewed the system, who designed the system, okay? Implementation, the cost of IT consultants who will implement new softwares, training of staff in new procedures, these all deal with cost. Okay, maintenance of the systems, periodic patches have to be sent to the IT systems to upgrade our softwares. Okay, monitoring and review to ensure that we are up to date with the current developments. What about the benefits? Usually, they will look at reduction of identified risk, reduction in lead times, okay, or improving the efficiency rate or the productivity rate of employees. Okay, that could also form part of the benefits. And at the end of the day, it should help us achieve targets, whether monthly targets, yearly targets, okay, semi-annual targets, quarterly targets. Okay. And then we look at application of internal controls, and these are what we need. Okay, for all that we've said, internal control systems should help us meet organizational objectives. Okay, in all aspects of operation. So it could be meeting the financial targets, okay, or the operational targets, or the project management targets, various dimensions. Okay, one example where we can apply internal controls is fraud risk management. You can apply it also to any other area of risk management. Okay, so here we're just taking fraud risk management as an example. So in terms of fraud prevention, for example, we look at anti-fraud culture, which must be instituted and communicated to everyone in the organization. There should be risk awareness to everyone, and also avenues for whistleblowing so that you can go in and report something you find suspicious. And of course, for all this to exist, we should have sound internal control systems. Okay. Now, usually we have what we call the fraud policy statement, and effective recruitment policies and internal controls can help minimize the risk of fraud. So, if the company can communicate clearly these policies, these controls, and then the statements, it helps everyone be on guard to know that we stand up to prevent fraud from occurring in the organization. But what if the fraud has already occurred? How do we detect it? We perform regular checks. Okay, we plug in some warning signals, fraud risk indicators. Okay, so failures in internal control procedures should trigger something. Okay, lack of information provided to auditors should trigger an alert. Okay, unusual behaviors by staff living extravagant lives, showing some moody lifestyles, not taking annual leaves, it should trigger something. Accounting difficulties, we're finding it hard to reconcile our balances. We're trying to plug almost everything into suspense accounts. It should trigger something. Okay, now of course, whistleblowing is key. It's key in detecting fraud. And then again, after we've detected fraud, what do? We respond. Okay, the response plan should be disciplinary actions. Those who are culpable or who are found culpable should be disciplined. If there are litigations, we should trigger them. Okay, um, take up criminal prosecutions and then find those who are responsible to plug off or to become like the goal owners of these activities to ensure it doesn't occur. Finally, my final words is that I've uploaded some articles, sample articles, practical guidelines on internal control processes and activities in an organization. Specifically, we see materials on internal controls on fixed assets, on the sales and collection processes, accounts payable, and then HR and payroll functions. Usually, these are the red flag areas where you see internal controls being relaxed and even fraud risk occurring most of the time. Okay. So if you are using any of these materials, I will still highlight that kindly acknowledge the sources. Okay, kindly acknowledge these sources because these are protected by copyright. So you should clearly, I always state this. Okay, now remember your knowledge that you've gathered from auditing and assurance modules from prior years in accounting foundation courses. Okay, we need them. We need them. When you look at the coursework, you see real case studies, and we are asked to identify risks, internal control weaknesses, the effects on organizational processes, and make practical recommendations. So all the materials I've uploaded there, if you take your time to glance through quickly, you see that you get most of the solutions to the case study. Internal control is key to all, to those of us who are going into industry, who are already in industry, those who are going into practice, who are already in practice, and those who are into academics, okay, we the accounting researchers, or those who will be coming back to accounting or to in academia. It's ever evolving. We need to monitor and review it and ensure it is up to standard, up to date. Currently, like I said, we are all going automation, IT controls. So IT controls is very important. Let's take the pains, the time to see how best we can review automation processes in our current dispensation to ensure that we are up to speed. All right. So that is it for the first part of our topic for this week. So we'll take the next step looking at internal audit. Okay, internal audit, we'll link it to the internal controls again and see how best we can make a complete study. Thank you. See you soon. Bye.